Two people take the same loan from the same bank. One of them struggles for years trying to pay it back. The other uses that same credit to increase income, lower risk, and gain freedom. Same system, same money, completely different outcome. In this video, we're going to walk through how bank credit can be converted into income-producing assets, what qualifies as real leverage, and how to avoid the mistakes that trap people in debt instead of freedom. By the end, you'll understand what bank credit should never be used for, what actually qualifies as an income-producing asset, how to evaluate opportunities before borrowing, and the simple rule that keeps leverage from becoming liability. This is where most people go wrong. When bank credit hits an account, the brain treats it like income, but it's not. Credit is future labor pulled forward. That means every borrowed money already has a job. It must either produce cash, save money, or increase future earning power. If it doesn't do one of those three, it's not leverage, it's consumption with interest. That's why using bank money to buy phones, upgrade lifestyle, travel, impress people, or feel successful creates stress, not freedom, because none of those things help repay the debt. An income-producing asset doesn't have to be big or glamorous. It simply needs to meet one condition. It contributes directly to cash flow or earning capacity. There are three main categories. Number one, assets that generate cash flow directly. These are the clearest form of leverage. Examples: equipment for a service business, inventory for a proven trade, a digital asset with existing revenue, a small business already generating income. The key word here is proven. Leverage is not experimentation. Leverage amplifies what already works. If the asset can't realistically generate income within the repayment window, it's a risk, not leverage. Number two, assets that reduce future expenses. This category is often overlooked, but powerful. If bank credit helps you permanently lower expenses, it increases financial freedom indirectly. Examples: tools that eliminate outsourcing costs, equipment that replaces recurring payments, systems that reduce operational waste. Money saved is money earned, especially when it compounds monthly. The mistake people make is buying convenience instead of efficiency. Number three, assets that increase earning capacity. This is the slowest form of leverage, but sometimes the strongest. Examples: skilled-based education tied to income, certifications that unlock higher paying work, tools that allow you to charge more. The condition is simple. If the education or tool does not increase income, it's not leverage. Learning without monetization is consumption disguised as growth. Before using bank credit, ask one question: how does this help pay itself back? If you can't clearly answer that, don't borrow. Simple. Good leverage has a clear income path, a realistic timeline, a margin of safety. Bad leverage relies on hope. Hope is not a repayment strategy. A common mistake is trying to use leverage at the wrong scale. Someone with unstable income, no systems, no experience should not be taking large loans. Leverage works best when income is predictable, costs are controlled, and execution is proven. This is why successful people start small, then scale. They don't chase big leverage. They earn access to it. Once the asset produces income, discipline matters. The first cash flow should go toward debt repayment, reinvestment, strengthening reserves, not lifestyle upgrades. Lifestyle inflation kills leverage faster than failure. Freedom comes from keeping cash flow working, not spending it prematurely. This is how people quietly build financial freedom. This is what it looks like in practice. 1. Borrow modestly. 2. Deploy into income-generating assets. 3. Use cash flow to repay debt. 4. Build trust with the bank. 5. Access larger capital. 6. Repeat at a higher level. This is how leverage compounds. Most important thing to remember is if the borrowed money can't help pay itself back, it's not leverage. It's debt wearing a disguise. Banks don't trap people accidentally. People misuse credit emotionally. The moment you use credit strategically, banks stop being obstacles and start being tools. That's where real financial freedom begins.